My next guest, he's also a stock picker like Mr. Adam Johnson, and he's been critical of the market, but now he's got a little bit more of a rosier short-term outlook. Now, he believes that the artificial intelligence trade, AI, and the semiconductors, he thinks they're back. He says this is extremely bullish for the markets. He added to his argument that there was an artificial intelligence summit in Paris last week where the European Commission said that they're going to spend a further 200 billion euro on artificial intelligence. France announced another 100 billion euro. So this is all on top of the other tech names that have committed to massive CapEx numbers. He's also been really active in NVIDIA. So personally, I like a man with a plan. He has his short-term goals and an outlook that thinks that prices in the short term won't be pretty good, he believes, until things fade closer to the middle of the year. Why don't we bring him on, have him on the show and make him state his own case in person? So let's go. Mr. Eddie Ghabour. He's the co-founder of Key Advisors Group, LLC. All right. I liked what you had to say. I saw you on television the other day. I read your notes. You got a pretty good feeling up until about the middle of the year, and then things kind of get a little bit more dicey for you. Why don't you explain?
Yeah, I think the big driver really that if there was one data point for everyday investors to look at is just track that 10-year yield. That's going to drive the bus in my opinion. And right now, I think what we're going to see over the next couple of months is false hope that inflation is behind us, because I think we're going to get some numbers that show moderation. It's going to keep the 10-year under that 4.7, and I think the setup for March is extremely bullish. And this is why we have tilted our positions to be bullish. And the AI trade, because of the concentration that's in the NASDAQ and in the S&P, to me, it's mathematically difficult to get the S&P to new highs without names like NVIDIA being the leaders due to just the way the math works. So we think we're going to get that blow off top, and sell in May and go away may actually be a real thing for us this year. So we think inflation after the next two reports is going to show some reacceleration. That's going to take the 10-year right back to that 4.7, 4.75, and ultimately get us to that 5%. On the 10-year. And in that scenario, you could see a pretty sizable drop in the S&P. Our job is to risk manage and get the hell out of the way, excuse my language there, before you have that major drop, because I think you'll have some amazing opportunities on the back end of that. So we're going to ride the trend for the next couple of months until that trend ends. Then we will cut bait. And then we'll have, if we do have a crash like that, it'll be in a non-recessionary environment, which means it may only last 4 to 6 months. And then 2026, 2027, with good policy and hopefully good growth, we could be right back into another bull market. So 2025 is going to be the tale of two stories.
All right. That's interesting you say that. So I read some research just recently. Deutsche Bank put it out. Maybe you've seen it yourself. But for the year, this year, 2025, they think that we're going to see a 10-year yield that averages 4.75. That's probably more in line with what you're talking about, maybe a little bit. But they still think that we can, appreciate 10 to 15% in the equity markets. What do you think about that?
Well, that's easy to say, but what's the path to get to 10 to 15%? Right. What I think is, I think you could see a 10% move in the market, but we think that's going to be in the first half of this year, because I think you could see that potential to be in that 10% range, but I think you're going to see a 15 to 20% drop that's going to materialize this summer, because no one is prepared for a 5% 10-year. I think consensus is thinking that the worst is behind us on yields.
That's true.
And usually consensus is wrong. So in my career, when I have made a call that is not real popular, it has a pretty good batting average. So I hope I'm wrong, because my life is a lot easier if we just continue to trend upward for the next 12 months. But we've told our clients 2025, we're going to have to be nimble, and buy and hold is not going to work for us this year like last year.
Yeah, there's a lot of more research out there saying 4% before 5% in that 10-year. I'd like to see how that happens, but it's going to be interesting. So going back to your sell in May and go away, are we talking, your overall non-recessionary sell-off, 15%, 10%? Where do you think?
I think 15% will be our best case on the S&P. I don't think anyone can argue, even though we own these names like the NVIDIAs and the Metas, no one can argue that the market is pricey, right? Yeah. It is overpriced, but we know it can be, those blow off tops, those PE ratios can get much higher, and we think that they will. So we need to call it a recalibration. It's not just the fact that we're going to get a reacceleration of inflation and we have 10-year yield going up. Our government has the largest amount of U.S. debt that has to get refinanced this year in history. On top of that, if DOGE does its job and takes $1 trillion to $2 trillion of government spending out of the equation that we would like to see, there's a price to pay for that. If putting $2 trillion extra dollars in causes things to overly inflate, taking $2 trillion out will cause it to deflate. So to me, you're checking off a lot of boxes that's saying the dark cloud is there. You have to pay attention to it. And it's going to come here this summer, the way these things are aligning between the refinancing of the debt, the inflation numbers, and what DOGE is doing.
I think I'm a little older than you, but there was a time, Eddie, where everybody followed that M2 number almost as closely as they look at, say, non-farm payrolls and see how much money has been put in the system or taken out of the system. I've been talking about it a lot. You're exactly right. When you overflow, you put 10 trillion, we put 20 trillion in globally 4 years ago. 10 of it was us, and the 10 trillion was the rest of the world. You try to take that out. I mean, we were buying a positive GDP. We weren't even getting a real big bang for our buck either. But at the same time, you're exactly right. When you start to take that capital out of the system, then you got a problem. I mean, that's how you get cheaper prices, but maybe not the way you want them. I appreciate you coming on. Awesome to talk to you again, Eddie. You're a smart guy. We're going to follow what you had to say. Eddie Ghabour coming to us from Lowe's, Delaware. Thanks for being on the show. All right.